Welcome back to Marginal Thoughts.
Great to be here.
So, you're thinking about trading, dipping your toes in,
Yeah.
then you've probably already hit that first big question. Do I open a cash account or a margin account?
Uh-huh. It's right there on the application form usually.
It feels like this massive decision you got to make right at the start, but what do they even mean? And how do you know which one is right for you, especially when you're just figuring things out?
It's a really important distinction.
Yeah.
It fundamentally changes how you can trade and maybe more importantly, the kind of risks you're taking on.
Absolutely. So stick around, folks. We're going to break this down plain and simple, cut through the jargon.
Yeah, hopefully help you feel a bit more confident making that choice.
Okay, so maybe you're literally filling out that form right now, staring at these two options.
It happens.
Yeah.
And understanding the basic difference before you click submit or place that first trade, well, it's pretty crucial.
So our mission today.
Let's simplify cash and margin. Lay out what they are, the key features,
Yeah.
the pros, the cons.
And help you figure out which might be the better launching pad as a beginner.
Exactly.
All right, let's start with the cash account. This always sounds like the basic model. The simplest one. What's the deal?
It really is the most straightforward type.
Yeah.
The core rule is simple. You can only trade with the money you actually have in the account.
Like a debit card, right? Spend what's there.
Precisely. If you put $1,000 in, you can buy up to $1,000 worth of stock or whatever else. No borrowing, no credit line. Your buying power is your cash balance.
Okay, makes sense. If I have $1,000, I can buy $1,000's worth of shares.
That's it.
But I heard there's a catch. Something about getting your money back after you sell? Settlement.
Ah, yes. This is a big one, especially if you're thinking about trading actively. It's called the settlement period. When you sell something, a stock, an option, the cash isn't instantly available to use for a new trade.
How long does that take?
Well, it depends. For options, it's usually 1 business day. People call it T+1.
T+1.
And for stocks, it's typically 2 business days, so T+2.
2 days. So if I sell shares on a Monday, I can't use that specific money to buy something new until Wednesday.
Generally, that's right. The funds need to officially settle. And trying to trade with that unsettled cash before it clears, that can lead to what's called a good faith violation.
Ooh, that sounds bad.
It can be. Rack up too many of those, and your broker might restrict your account, like forcing you to only trade with fully settled funds from then on. So patience is key there.
Okay, so despite that waiting period, what makes the cash account a potentially good starting point for a beginner?
Well, the biggest pro is just that simplicity we talked about. It's much easier to wrap your head around.
No borrowing, no interest calculations?
Exactly. What you see is what you get. Your money's your money.
Mhm.
Your buying power is clear. There's just less to, mess up or misunderstand when you're learning.
And I guess that simplicity links directly to risk management.
Absolutely. And this is probably the most important point for new traders. With a cash account, you literally cannot lose more money than you deposited. Period.
So no going into debt with the broker.
Nope. It's impossible. That acts as a fantastic built-in safety net.
Look, when you're learning, you are going to make mistakes. It's just part of the process.
Better to make them with limited downside.
Far better. Better that a mistake costs you some of the cash in your account, not put you in the red owing money.
Now, this is where it gets interesting for people who maybe do want to trade a bit more often, but don't have, say, $25,000 yet. That pattern day trading rule.
Ah, the PDT rule. Yeah, causes a lot of confusion.
Here's the key thing for cash accounts. As long as you are only trading with settled funds.
The money that's cleared from previous sales after that T+1 or T+2, wait.
Exactly. As long as it's settled cash, you are not subject to the pattern day trading rule.
Wait, really? So I could buy and sell the same stock multiple times in one day?
With settled funds, yes. You could theoretically make dozens of day trades a day, provided you always have enough settled cash to cover each new purchase. The PDT rule, which limits day trades, just doesn't apply in the same way as it does to margin accounts under 25K.
Huh. So that allows for more frequent practice, maybe with smaller amounts, just cycling through settled cash.
Precisely. It lets you get those reps in, which is so valuable for learning. You just have to manage the settlement timing. And of course, if your plan is more buy and hold, investing for the longer term.
Then the settlement delay isn't really a big deal anyway.
Right. And one other small potential plus. So sometimes, depending on the broker, the uninvested cash sitting in your account might earn a little bit of interest, maybe in a money market fund.
Okay, so simple, limited risk, and crucially, freedom from the PDT rule if you use settled funds. Sounds pretty compelling for beginners. What's the downside? What am I missing out on?
But the main limitations are around the types of trading strategies you can use. Generally, you can't do things like short selling.
That's betting on a stock price going down, right?
Correct. And you also typically can't access more complex options strategies, particularly those that involve selling options or creating spreads, because those usually require margin privileges. You're mostly stuck with just buying assets going long.
Which means, naturally, less buying power than someone with the same starting cash but using margin.
Yep. Your position size is strictly limited by your cash balance. And as we discussed, that settlement delay can definitely be frustrating if you do want to rapidly redeploy capital after a sale.
Okay, let's flip the coin. Margin accounts. This is where it gets maybe more exciting, but also more complex.
That's a good way to put it. The absolute core difference is borrowing. A margin account lets you borrow money from your broker.
Using my own money as collateral.
Exactly. You use the cash and securities you already have in the account as collateral. That's your margin. The broker then lends you additional funds based on that collateral.
Which boosts my buying power. That's the leverage thing.
That's leverage, yeah.
Yeah.
It increases your buying power beyond your cash deposit. So maybe you put up $500 of your own money, but the broker lends you another $500 based on that. Now you can control a $1,000 position.
So my $500 is doing the work of $1,000.
In effect, yes. Or another way brokers might frame it is offering, say, 4.1 leverage for day trading. So if you have $5,000 cash, they might give you $20,000 in day trading buying power. That leverage magnifies your potential exposure.
Okay, more buying power. Sounds good, but that borrowed money isn't free, is it?
Definitely not. And this is critical. You pay interest on any money you borrow. It's called margin interest.
Like interest on a credit card loan?
Pretty much. The rates vary, but if you hold margin positions for a while, those interest costs can really eat into any profits you might make. It's an added expense you don't have with a cash account.
So besides the buying power, what are the other big advantages of using margin?
Well, that increased buying power is the main draw. If a trade goes your way, leverage can significantly boost the percentage return on your own capital.
And it unlocks those other strategies, short selling, options.
Exactly. Margin is generally required for short selling. And it opens the door to the full suite of option strategies, selling puts, selling calls, trading spreads, strategies that just aren't available in a typical cash account.
What about settlement? Does that T+2 delay go away?
Yes, that's another major benefit, especially for active traders. When you sell a security in a margin account, the proceeds are typically available to trade with again immediately. No waiting for settlement.
Instant cash availability. Okay. More power, more strategies, faster cash. Sounds tempting. But what's the catch? What are the big risks, especially for someone new?
The catch is huge, significantly higher risk. Just as leverage magnifies your potential gains, it magnifies your potential losses equally, or even more so.
How so?
Because you're trading with borrowed money. A relatively small percentage drop in the price of the asset you bought on margin can wipe out a much larger percentage of your actual capital. Yeah, and crucially, you can lose more than your initial deposit.
More than I put in, so I could end up owing the broker money.
Absolutely. If a trade goes badly against you on margin, you could lose your entire initial investment and still owe the broker the money you borrowed plus interest. That's how people get wiped out.
Wow. That's scary. I remember hearing about the 1929 crash and margin debt.
That's the historical cautionary tale, yeah. Leverage is powerful, but it demands extreme respect. It's like handling fire, useful, but dangerous if you're not careful, especially when you're just learning to handle matches, so to speak.
It also just sounds way more complicated to keep track of everything.
It is. You need to understand margin requirements, maintenance levels, track your borrowing, the interest costs. It's just more moving parts than a simple cash account. Plus, most brokers require a minimum account balance, often $2,000 or maybe more, just to get margin approval in the first place.
And then there's the infamous margin call. What exactly happens there?
Okay, this is probably the scariest part for many. If the value of the securities in your account drops, your equity, the value of your assets minus what you owe also drops. If your equity falls below a certain percentage, the maintenance margin,
Which the broker sets.
yes, set by the broker and regulations. If you fall below that level, the broker issues a margin call. That means they demand you deposit more cash or marginable securities immediately to bring your equity back up.
And if I can't, or don't do it fast enough,
Then the broker has the right to liquidate force, sell your positions. They can sell your stocks or options, often at the worst possible time, at a loss, to cover the shortfall. And they don't need your permission to do it.
They can just sell my stuff without asking.
Yep, it's in the margin agreement you sign. They do it to protect themselves from you defaulting on the loan.
Okay, that's a serious risk. Now, how does the pattern day trading rule come back into play with margin accounts?
Right. This is where it gets tricky for accounts under $25,000. If you have a margin account and your account equity is less than 25K,
Which is common for beginners.
very common, then you are subject to the PDT rule. This strictly limits you to making no more than 3 day trades within a rolling 5 business day period.
3 trades where I buy and sell the same security on the same day.
Correct. Or sell short and cover on the same day. Make that 4th day trade within 5 days, and your account typically gets flagged as a pattern day trader.
And that's bad because
It usually leads to restrictions, often requiring you to maintain $25,000 in the account to continue day trading, or potentially locking you out of making opening trades for 90 days.
So wait, this is the big trade-off then for someone starting with less than 25K.
It really is. It's often the biggest point of confusion.
In a cash account, I can make unlimited day trades, but I have to wait for funds to settle each time.
Correct. Using only settled funds avoids the PDT rule.
In a margin account under 25K, I get instant settlement. The cash is available right away. But I'm hard capped at only 3 day trades in a 5-day window.
That's the dilemma. Speed versus frequency, essentially.
It feels like that PDT rule, even though it's meant to protect people, it could actually push someone into making a worse decision.
It absolutely can, and often does. We hear stories all the time. Someone's in a losing day trade, they know they should cut the loss, but
They've already used their 3-day trades for the week.
exactly. So instead of taking the small loss and violating the PDT rule, they think, okay, I'll just hold it overnight, and maybe it'll come back tomorrow.
And then the stock gaps down hard pre-market.
And suddenly that small, manageable loss they should have taken becomes a much, much bigger loss, all because they were trying to avoid the PDT flag. It's an unintended consequence of the rule.
Wow. Okay, so pulling this all together,
Hmm?
how does a beginner actually decide? Cash or margin?
Look, it really boils down to your personal situation, your goals, how you plan to trade, your comfort with risk. But for someone genuinely just starting out with little or no experience, the overwhelming advice is usually start with a cash account.
Why so strongly recommended for beginners?
Because your first priority shouldn't be maximizing leverage. It should be learning.
Yeah.
Learning the platform, learning market basics, learning risk management, learning, and this is huge, to control your emotions.
Fear and greed.
Fear and greed, yeah. A cash account forces discipline and limits your potential damage while you're on that steep learning curve. Adding leverage from margin right at the start, it's like pouring gasoline on the inevitable small fires you're going to start as you learn.
Making those early mistakes much bigger, much faster.
Exactly. Better to make small, affordable mistakes in a cash account, where the worst that can happen is you lose the money you put in. Plus, remember the practice aspect.
Right, the unlimited day trades with settled funds.
It allows you to practice frequently, taking small positions, getting comfortable with placing orders, managing trades, without the pressure of PDT or the dangers of leverage. Yes, you miss out on shorting or fancy options.
But maybe beginners shouldn't be doing that stuff right away anyway.
Probably not. Master the basics of buying and selling first. Build a foundation.
Are all brokers the same in how they offer these?
Not entirely. You really need to check the specifics with the broker you're considering. Some brokers might push you towards margin, especially for certain things like options. Others are very clear about offering true cash accounts for both stocks and options, letting you bypass PDT by managing settlement.
So read the fine print.
Always read the account agreements. Understand exactly what you're signing up for.
And hey, this isn't a forever decision, right? I can change later.
Oh, absolutely. You can typically apply to upgrade a cash account to margin later on, once you have more experience, maybe more capital perhaps over that 25K level. Or you could even have both types of accounts eventually. The point is, start where it makes sense for learning safely.
The absolute bottom line, though, regardless of account type.
Understand the risks, have a plan. Don't trade with money you can't afford to lose. That applies whether it's cash or margin.
So there you have it. Cash versus margin accounts broken down. It might seem like just a checkbox when you sign up.
But it has really big implications for how your trading journey unfolds, especially at the start.
Think about your goals, how much risk you're truly comfortable with, and how you actually want to trade day to day.
And for most people just starting out, keeping it simple and safe with a cash account is often the smartest first step. Focus on learning without the extra dangers margin brings.
We'd love to hear your thoughts. Are you using cash or margin right now? What was your experience choosing? Or maybe you're deciding right now. Let us know in the comments.
Yeah, share your experiences.
And if this conversation helped clarify things, give us a like. For more chats about trading and finance, make sure you subscribe to Marginal Thoughts. Now, here's something to think about. How much do you think the psychological pressure, knowing you could get a margin call versus knowing you have to wait for cash to settle, might subtly change your trading decisions, even beyond the technical rules? Something to chew on. We'll see you next time.